Good morning, Abigail.
Good morning.
Okay. So we pick up. Did you manage to do the questions I listed? But as in
Yeah.
Abigail, where will you manage that?
Yeah.
And they are okay, still?
Yeah, they are.
Okay.
Apart from the I'm saying apart from the one for the EOQ, the annual savings, I got lost somewhere.
The one for EOQ.
Yeah.
So maybe we can look at it. So it was the paper of September 2015, question 1B. So we are told to do the EOQ, the economic order quantity. Economic order quantity. Economic order quantity. Now this one, EOQ, is supposed to be 2RS. We divide by CI. Divide by CI. And I told you when it comes to this one, you identify these items, and R, I told you it represents the annual demand. The annual demand. According to this question, we are told shoes and boots limited sales 5760 boots in a week. So the annual should be 5760 multiplied by 50 weeks, because we are told the purchase price is 250 per boot. The company currently orders in 12 periodic installments. Ordering and related costs amount to shillings 12,500 per order. The stock holding cost is 25% of inventory value. The company has a 50-week working year. We are required the economic order quantity. So multiply these ones. We have here 288,000 boots. Then S, what tunasema is the fixed cost per order. Fixed cost per order. Fixed cost per order is change. Ordering and related cost amount to 12,500. Then C is unit purchase cost. Unit purchase cost. So unit purchase cost is shillings 250. Each boot is 250. I is the cost of capital percentage. Cost of capital percentage. Cost of capital percentage. And cost of capital percentage, we are told it is 20%. So with that now, our EOQ should be 2 times 288,000 times 12,500. You divide this by 250 multiplied by 0.2. You get the square root of this. The square root of this. 12,000, eh? Okay, 12,000 units. 12,000 units. Okay, there is something else, although it has not been asked, that we call annual orders. Annual orders. If they were to tell you to get annual orders, it is given as N being equal to R out of Q. That is 288,000. You divide it by 12,000. Those will be how many orders? 24 orders. 24 orders. So ukiulizwa frequency, ukiulizwa the frequency of ordering, you will say you order every or after every 50 out of 24. Every 2 weeks, eh? Every 2 weeks. After every 2 weeks. In other words, the gap between the whatever will be 2 weeks. Then the next thing is purchase costs. Purchase costs is normally given as what? R times C. So this will be 288,000 multiplied by 250. 72 million. 72 million. Haya, kuna mwingine huwa anaitwa ordering cost. It is R out of Q times S. So it is 288,000. You divide by 12,000, multiplied by 12,500.
300,000.
300,000, yes. Na mwingine anaitangwa holding costs. It's given as Q out of 2 multiplied by CI. So this will be 12,000. You divide by 2 multiplied by 250 multiplied by 0.2.
300,000.
300,000. Na kuna mwingine anaitangwa total costs. So total costs will be 72 million plus 300,000 plus 300,000. So that is 72,600,000. Yeah, those are the basics. Anytime you see the EOQ, those are the things that they can easily ask you to compute. Those are the things that they can easily ask you to compute. So you have copied here. Have you guys also have copied there?
Yeah.
Good. So that now I get space to answer the second one. Annual savings. So the question is asking for annual savings. So if you are told to get the annual savings, it means you need to get the current costs. The current costs minus the EOQ costs. The current costs minus the EOQ costs. So the EOQ costs, we already have computed to Kabata in shillings, 72,600,000. So the current costs, the company currently orders in 12 periodic installments. So maybe this one we could put it this way: currently orders, they are 12. Because we are told the company currently orders in 12 periodic installments. So they make 12 orders. So Q is 288,000. You divide by 12. You have to do how many units they place per order. 24,000 units. So the costs will be R times C plus R out of Q times S plus Q out of 2 times CI. The same thing to Guanapale. So this will be 288,000 times 250 plus 288,000. We divide by 24,000 multiplied by we will get 12,500 plus 24,000. You divide by 2 multiplied by 250 multiplied by 0.2. Napata ngapi? 750,000. Thus, savings, the annual savings will be 72,750,000 minus 72,600,000. So that's a saving of 150,000. Abigail, are you getting those figures?
Yeah.
So are you clear now on where you got stuck?
Yeah, I'm clear. Thanks.
Talking about it. The next question is coming from May 2016, question 3. May 2016, question 3. We are told MS Enterprise manufactures 2 products, namely P and Q. Information relating to each of these 2 products for the month of April is as follows. We have the opening inventory, production, sales, sales price, unit costs, fixed costs. We have all that. We prepare the income statements for those things. So as I've always told you, when you come across questions, marginal and absorption, there are 2 things that you should quickly prepare. One is the unit cost. Unit cost. And matters unit costs, there are 3 of them. The first is marginal. And marginal, I have always told you, you capture the variable production costs. You capture the variable production costs. So there are 2 products here. So then we need to separate. Kwanza ni PQ. So PQ, ukiangalia mahali tumepewa unit cost, kuna material which is a production cost 8. Kuna labor which is a production cost 4. Kuna variable overheads which is a production cost 2. But the other variable sales overheads, that is not a production cost. Sales is not a production cost, it's a non-production, so it should not be put here. So that gives us shillings what? 14. Huyu mwingine QP, you do the same thing. It is 14 plus 2 plus 1, and that is 17. So the first cut in this kind of a question, ilikuwa hiyo variable sales overheads. Most people just say, marginal tunaweka variable, so unakuja umeweka zote. But it's not every variable. It is the variable that is for production. The next thing that you need to get is what we have been calling the fixed overhead absorption rate. The fixed overhead absorption rate. So according to information 2, we are told the budgeted fixed production overheads amount to 45,000 for a normal combined output of 22,500 units for PQ and QP. So this one will be equal to 45,000, the budget amount. You divide by the combined production units, and that will be shillings 2 per unit. Per unit. There will be 2 bob per unit. So when now you come to absorption, PQ will then be 14 plus 2, and that is 16. QP will then be 17 plus 2, which is 19. The second thing that you should get right is what we call the stock schedule. The stock schedule. So the stock schedule, we have details here, and we always begin with opening stock. you add production, you less sales, and you get a figure called closing stock. You get a figure called closing stock. So we have two things here. We have PQ and we have QP. So the opening stock is 0 for both. It's already provided. Production is 15,000. This is 6,000. Sales, this is 10,000. And this is 5,000. So that means here we close with 5,000. And here we close with 1,000.
1,000.
So we will have now marginal costing. Marginal costing, income statement. So the statement will have 3 columns, but we can first of all just the first one, which is called details. Now for details, we will have sales revenue, you less opening stock, then you have production, you get or you less closing stock. That will give you something called cost of sales, so that you get something known as gross contribution. Gross contribution. Then you less. We already know the variable and production. So the variable and production, we can call them variable sales overhead, variable sales, let's just call them costs or overheads, whichever. When you do that, you get a figure called net contribution. You get a figure called net contribution. Then you less fixed costs. Now the fixed costs, what to gonna, we can just bring them up, all of them, the way they are. So tuko na huyu anaitwa production. Tuko na mwingine anaitwa administration. Administrative. Tuko na mwingine anaitwa sales and distribution. Sales and distribution. Yeah, these are two. So that will give us something called net profits. Give us something called net profits. So sasa hii tutagawanya mara mbili. So this is PQ and this is QP. Maybe our figures are in thousands. Our figures are in thousands. So if the figures are in thousands, for the sales revenue, this one we have sold 10 at a selling price of 20. So that gives us 200. This other one, we have sold 5 at a selling price of 30. That is 150. Tukikuja hapa, the opening stock here is 0. And when we are in marginal, PQ is valued at 14. So that gives us 0 here. And the same case here, 0 times 17. We get a 0 there. Production, PQ, we have produced 15, each at 14. So if you take your calculator, 15 times 14, unapata 210. 210. When you come to this other side, we have produced 6, each valued at 17. So 6 times 17, you're getting 102. 102. When you come to the closing stock, PQ has 5. So 5 each at 14. You get 70. Na hii ni ya kutoa. Then this one has 1 times 17. So hiyo ni ya kutoa. So with that, we now come and write here, so that we will be able to get our cost of sales. In 140, which should be negative, and this one is 85, which is negative. Gross profit, gross contribution is, this one is 60 and 65. And 65. So the variable sales, not unless otherwise provided, not unless you are told otherwise, you take the per unit, you multiply by the unit sold. Then on production, not unless you are given the figure or you are directed otherwise, you take the units that were sold easy, 10, you multiply by the variable, which is 2, so that gives you 20 there. Then hapa 5 units multiplied by 3, which gives you 15. Which gives you 15. So sasa, unitafutie the net contribution for PQ is PQ 40. Now we will give any 50. The beginning is 50. Twende now for our fixed. Now these costs, we're just given a single figure. We are not told how much belongs to who. But going by what we are told that they are combined by information 2, we will share them between the two. We'll share them between the two. Such that tukikuta kwa hii ya 40, it will be 40 you divide by 2. So we make a 20 hapa, and you do the same thing here. 40 divided by 2, we make a 20. We give them equal. Admin, hii 15, you divide by 2, so that you record 7.5. 15, you divide by 2, 7.5. Selling is 25. You divide by 2, 12.5. So 25, you divide by 2, 12.5. So based on that, give me now the profits. Kwanza is 0. The second one, 10. 10. Abigail, have you finished?
Almost. Yes.
Okay. So if yes, then we can clear so that we now go to absorption costing. So hii nayo tutakuwa na gross profit here. Then tutaleta fixed production cost here. Na hii huwa tunaleta kwanza absorbed, ikifuatwa na actual, so that we get over or under absorbed. Then tunaleta non-production costs. Non-production costs. So hizi non-production costs, we have administrative. We have sales and distribution. But this one for sales and distribution, there are 2 of them. We have a component that is fixed, and we have another one that is variable. Then that will afford us the net profit. That will help us get the net profit. So finish up that so that we feel together. So now, from there we can start recording. As usual, opening is 0 times 17, so that is 0. Then 0 here times, no, it is 16 times 16. And here it is 19, so that is still 0. Production is 15 times 16. What do you get? 240. 240. Then we will give it 6 times 19 is 114. Closing stock is 5 times 16. We get 80. Then 1 times 19. Get 19 there. So sasa hii 0 plus 240 minus 80, you get what? 116. Now we're beginning 95. Get 95. Gross profit for the first one is 40. 40. Now we're beginning 60. 150 minus 95. 55. 55. When you come to the absorbed, what you do, you take the units produced, these ones, 15, multiplied by the FOER, this one, which was 2 shares. So multiplied by 2, that gives us 30. Then you do the same thing here, 6 multiplied by 2, that gives us 12. Now, actual is the fixed production that we had put. Is the fixed production that we had put in the marginal, which was 40 divided by 2, 20, and we are subtracting this one. The same case here, 40 divided by 2, that is 20, and we are subtracting so that we're able to know. So the first one, the difference, 30 minus 20 is 10. Now that is an over absorption. We absorbed more, so it should be added back. This one, the difference is 8. We absorbed less, so we are supposed to subtract it. We are supposed to subtract it. For the non-production, at the mean, the entire range of 15 divided by 2, That is 7.5. 15, you divide by 2, 7.5. Huyu mwingine, sales that is fixed is 25. You divide by 2, 12.5. 25, you divide by 2, 12.5. For the variable, it is just the same way we did with marginal. Tukachukua the unit sold 10, you can multiply na 2, that was 20. Na hizi zote nitatoa, you see, we are subtracting these ones. So, huyu naye alikuwa na 5 times 3, eh? So it is 15. Ya kwanza. Abigail, are you okay?
Yeah.
Okay. So the next thing that you're supposed to draw is the reconciliation statement. Is the reconciliation statement. Reconciliation statement. Now, in the reconciliation statement, we have details. And in the details, we always begin with marginal profits. Then we say less difference in opening stocks. Then we say add difference in closing stock. And when you do that, you get what we call absorption profits. That's the format that you should always have in mind. Anytime they ask you to do the reconciliation, so this is PQ and QP. So absorption profit, this is 10, this is 12, E equals 0, na E equals 10. Eh? So what you need to do is, for the opening stocks, all of them were zeros. Eh? For the opening stocks, all of them were zeros, so there is no difference. So for the closing, absorption hapa wametumia 80, wale walikuwa wametumia what? 70. So there is a difference of 10. For the QP, marginal wakatumia 19, wale walikuwa wametumia 17. So there is a difference of 2. Yeah, and you can see now it is reconciled. So in case they bring your way anything to do with marginal absorption, I now have confidence that you can handle it comfortably. The next, I want to go to the paper of November 2016. There are several questions I want to do. Starting with question 1C. The 1B. November 2016. Question 1B. Bread Limited manufactures and retails the product, namely ABC. The company employs 60 direct workers who work under a group bonus scheme. The company engages the grids of workers who are paid a bonus on the excess of time allowed over time taken. The bonus is paid at 75% of the workers' base rate and is shared by the workers in proportion to the time spent on the work. The following production data has been extracted from the company's records for the month of October 2016. So we have been given that, and we are told to get the percentage of hours saved to hours worked. So that percentage, we are told to get that percentage. How you shall go about it is to get the hours saved. You divide by hours worked, multiplied by what? 100. That will be the formula. So the next thing that you need to know is how do we get the hours saved? The hours saved will be obtained as the hours allowed you minus the hours taken. The hours taken. So trying to look for those two items, you realize that the hours that have been allowed are given in terms of the product. So we will have to come here and tupange namna hii. Takuwa na product hapa, and then the hours around. So you see product A, we are told to do 320 units. And each one is costing us 63 minutes. So these ones, you divide by 60. So that we know how many hours those are. 336. B, it is 640 at 120. You divide by 60. 1280. C, it is 1200 times 100. You divide by 60.
2000.
2000. So we get the total of that.
That is 616.
That is 616. 616. Yule mwingine tunahitaji with the hours taken. Ukienda kwa kuangalia the hours taken, it is given in terms of the grade. So itabidi tukuje tuipange namna hii. We have the grade and the hours taken. The grade, then hours taken. So grade 1, you can see we have 20 workers and each one worked for 30 hours. So that means in total, those are how many hours?
600.
600. Grade 2, we have 8 workers, each working for 64 hours. 512. Grade 3, we have that 2 workers, each working for 50. 1600. So total. 27. 12. So the hours saved must be that 616 minus 27, 12. 904. Those are the hours saved. Therefore, the percentage should be 904. You divide by the hours worked, 2712. 2712. Multiplied by 100.
33.3.
33.3%. So we have answered that. The next one is the bonus due to the group. So when it comes to the bonus, we are told the company engages 3 grades of workers who are paid a bonus on the excess of time allowed over time taken. The bonus is paid at 75% of the workers' base rate and is shared by the workers in proportion of the time taken. Okay. So, taipanga namna hii, itakuwa na grade it is the bonus is 75%. So tutakuwa tunasema 75% times the base rate. The base rate times excess time, and that excess time, it is the time saved. Ndio inaitwa excess, times the proportion, and that will give us the bonus. Times the proportion, that gives us the bonus. That is how we are going to get it. So tukianza grade 1, we will have 75% times the base rate. The base rate is 300 in grade 1. The time saved is 904. And the proportion is the time spent. So the time spent is this one, this time taken. So how they worked 600 in a total of 2712. In a total of 2712. $45. Two, it will be 75% of the base rate, which is 270, times 904 times 1280. You divide by 2712. Oh, sorry, the 512. Is 512. Divide by 2712. $34,560. Then 3 is 75% of the base rate, which is 240, times 904 times 1600. You divide by 2712. $96,000. So the total of that $175,568. That's the total bonus that is due to the group. So there is something else that we are taught to do, that is the gross earnings. And gross earnings should be computed like this. We should have nifukie on a table of its own. So that I have the grid. Yeah. Then I have the bonus, which is A. Now let me not call it A, so that does not confuse with this. Let me call it B. Then we will have the basic pay, which I want to call E. Then we will have the gross pay. And we know the gross pay will be D plus E. So here basic, go a little bit wider because it has a small working. So grade 1, 2, and 3. So for the bonus, grade 1, this is 45,000. This is 34,560. Maybe unaweza weka mtoto hapo chini. Na hii 96,000. Now the basic pay will be the hours taken. The hours taken, you multiply by the basic. So kama hawa sasa tasema ni 600 times 300. 180,000. So hiyo 180 ukiongezea hii 45. 225,000. Hawa wa grade 2 uchukue 512. Multiply by 270. 138, 240. So ukiongeza hii 172,800. Then hii ingine utasema ni 1600 times 240.
384. 384,000.
384,000. Good. So you are to 96. 480,000. So we are okay with that, eh? Abigail, are you okay?
Yes.
So we proceed. Look at question 2B of that paper. So it's the paper of November 2016. Question 2B. So we are told to use direct allocation or allotment methods. If you are told to use that method, you remember very well, we draw the overhead distribution sheets. The overheads distribution sheets. The overhead distribution sheet, which the first column is called overhead. The first column is called overhead. Which is followed by the base. Which is followed by the ratio. Which is followed by what we call multiplying factor. And then we have the departments. So we have department A, B, C, 1 and 2. Okay. So we always begin with allocated. So they are allocated are these ones that are given here. Maybe we could have our figures in thousands. Have our figures in thousands. So A has been given 800. B has 700, 500, 250, and 300. Then we come to the apportioned. Remember, allocated to December, they are the ones which are already given per department. You don't need to divide. Then the apportioned, they are the ones given a single figure. You need to divide and share to the departments. So this question does not have any of such nature. After that, you now go to do the third thing, which we call apportioned. Reapportioned. So reapportioning is where you are moving from the service departments. So from department 1, So from department 1, the base, we shall use the percentage. We shall use the percentage. And remember, when we are in direct allocation method, we always share to production departments only. So ukiangalia hapo katibu hapo, we will just take 20 is to 35 is to 25. Just those three, because you are supposed to share to 3 departments only. Is that okay? You can take them the way they have taken, or you could simplify. So the multiplying factor then will be the 250. You divide by, add these 3 ratios, 80. So 250 when divided by 80 is what? 3.125. I multiply by 20. 62.5. Multiply that by 35. 109.375. Multiply by 25. 78.125. Then these 250 inawekwa hapa, but in brackets hivyo, because it is from there that we are subtracting. And then here, there is nothing that is coming. The direct allocation does not give anything to the other service department. Then from department 2, we will still use the percentage. We'll still use the percentage. And ukiangalia hiyo katebo ya percentages ni 35 is to 20 is to 20. The amount that we want to distribute is 300. So this one we divide by what?
75.
75. You get what?
4.
4. So 4 times that 5, 140. Times 20, that is 80. And here we are receiving nothing. Then here we have 300. And then from there you get the totals. So that these 2 departments will end up with 0. So this is 1002.5. The others you can get them. My space is squeezed. Okay, so that is the direct allocation method. I still want to use the same question to remind you of the other method. Still want to use the same question. I want to remind you the other method called simultaneous equations method. Simultaneous equations method. So with simultaneous equations method, you proceed like this. You say let X to represent total cost of service department 1. The cost of service department 1. Y to present total cost of service department 2. Then what you do, unasema X is equals to haya. Ukiangalia how we get the total, so unachukua hii allocated, this 800,000 plus what this one will get from the other one. Why? Haya, sasa hii ka percent ukifuata uangalie row number 2 2, it is the one we are calling Y. Ni kumaanisha department 2 will give 35% to A. Can you see that? Department 2 will give 20% to B. It will give 20% to C. And it will give 25% to 1. Unafuata hiyo? Abigail, unafuata hiyo?
No.
Can you see where we have those percentages?
Yeah.
So we are looking at row number 2 for department 2. Are you there?
Mm-hmm.
And I'm saying department 2 will give 35% to A. Do you see that? Can you see that 5 anywhere?
Yeah.
Can you see 2 and A?
2 and A. Yeah.
So I'm saying department 2 will give 35% to department A.
Yeah.
Then department 2 will give 20% to B.
Yeah.
And department 2 will give what percent to C?
25.
Department 2, tumesema it is giving what percent to A?
Department 2 is giving 20%.
No. A. Can you see department 2?
Yeah.
Can you see A? Eh? Can you see what?
Department.
Mahali kumeandikwa 1, 2 hivi na A hapa. Can you see
Yeah.
something?
Yeah, which is 800.
Mimi nasoma yenye iko na percentages.
Percentage of A, department 1 is 20. Department 2 is 35.
Is?
I'm saying department A, department 1.
So first of all, tell me whether you can see something like this. Mahali kumeandikwa A, 1, 2, na A hapa which is 20%.
Yes.
And B and down here
35. Yes. Yes.
So this is what I'm saying then. Department 2 will give that 5% to A.
Mm-hmm.
So department 2 will give what percent to A?
That 5%.
So it will give what percent to B?
20%.
What percent to C?
20.
What percent to 1?
25.
That's how it's interpreted. So if it's going to give 25, it's going to give 25, then we will say X will receive 0.25 Y. Then we come to Y here. Department Y, it has, sorry, this one was wrong. This one is wrong. Because the cost of department 1 is not 800, it is 250. 250.
Yeah.
So department 2, it has 300. Can you see the 300? Ukifuata department 1 in the same argument, department 1 now will give what percent to A? Apply.
To A. Sorry?
Department 1 will give what percent to department A?
20. Oh, it will be.
You're not sure. Rather, it is going to give what percent? 20%. Can you see 20%?
Yeah.
Then it will give what percent to B?
35.
What percent to C?
25.
And what percent to 2?
20.
Yeah. So department 2 will receive 0.2 from X. So zinapangwa hivyo. They are actually opposite. You can see X, X here. Y here. They are opposites. So with that now you start solving. And you tell us on solving, let's look for X. X will be 250,000 plus 0.25 Y. So instead of kuandika now Y here, you bring the whole of this, which is going to be 300,000 plus 0.2X. So X will be 250,000. 25% of 300 is how much?
750.
75,000. Plus 25% of 0.2.
0.05.
05x. So putting like terms together, I will have x minus 0.05x being equal to 250,000 plus 75,000. So subtract this one. That one up.
0.95.
0.95x is equal to 325,000. So when I have 325,000, I then proceed and say that x should be 325,000. You divide by 0.95.
342,105.42.
105.
0.26.
So you can just leave it that way. Distributed as follows. Department A, from that table that we have read, Department A is getting what percent from Department 1? Yes. A is getting what percent from 1? 20%. Now once again, imesimamiwa na X. So sasa tutasema 20% of 342,105. $68,421. Department B is getting what percent from Department 1? 35%. So 35 of 342,105. Give me the answer and round up or down properly. 119. 730. 737. And Department C is getting what from 1? 25%. Abigail, I hope you are following.
Yes, I am.
Good. So what percent? Or rather, what amount? 85? 526. Then Y. Let us now solve for Y. We solve for Y. So Y tunajua ni 300,000 plus 0.2x, and we already know x ni ngapi? Ni 342,105. 342,105.
68,421.
421. Now this one, distribution or distributed as follows. So Department A is receiving what percent from Department 2?
35%.
35. So 35% of 368,421.
128,947.35.
128
947.35.
947, eh?
Yes.
B is receiving what percent from 2?
20%.
So 20% of 368, 421. 73, 642. 684. C is receiving what percent? 0.2 of 368, 421. So 73, 684. So what now I'm drawing is the overhead distribution sheet. So overhead distribution sheet. So under this method, you just have the overhead here. Then you don't need the other columns like we had in the other method. So you just go straight to A, B, C, 1 and 2. The reason as to why this one does not require those other columns is because already the workings have been shown up there. So this is actually a summary. But hizo zingine huwa zinafanya their workings inside there. That's why we have many things to show. But hii tushaonyesha. So hapa tutakuwa na allocated, tutakuwa na apportioned, then tutakuwa na reapportioned, from department 1, 2, and then we will have total. Then we will have total. So this is very simple. The reapportion is easy to tumepata hapa. Like for A, imepata 128, 947 hapa. Huyu akapata 73, 684. Huyu akapata 73, 684. That is from department 2. Maybe I also need to start from up here. This is 800, 700, 500,000, 250,000 and 300,000. So huyu amepata 68,421. Huyu akapata 119,737. Huyu akapata 85,526 wakati tulitoa hii 250. Na huyu hakuna kitu alipewa hapo. Huyu hakuna kitu alipata hapa wakati tulitoa 300,000 here. So this is 0. Yeah. Yeah, so we stop there for today. Tomorrow we'll still meet again, the same time. Is that okay, Abigail?
Yeah, sorry.
Okay, 11 to 1. Or what about 8:30? Abigail, would you be okay with 8:30?
Tomorrow. Sorry, I had lost you some seconds ago.
Okay, I was saying, what if you tomorrow from 8:30 to 10:30?
It's okay with me.
Okay.
Yeah, that is tomorrow.
Tomorrow, Friday.
Okay.
Thank you so much.
Thanks too.